In the foreign exchange markets, the local currency ended trading 2 centavos shy of its lowest ever record closing at 57 pesos and 16 centavos to the dollar. The peso fell to 57 pesos and 18 centavos last week against the greenback. Joining us now for more on the declining peso is OANDA Senior Market Analyst Craig Erlam, joining us from London. Craig, thank you so much for joining us. As we can see, the Philippine peso continues to fall to historical lows against the US dollar. How concerned are you with the depreciation?
Well, I'm no more concerned than I am about the depreciation of every other currency against the US dollar. This is really a US dollar story ultimately, as it is around the world. Everywhere right now we seem to be talking about record lows. Even here in the UK, the pound falling to multi-decade lows. You can see the euro struggling, the yuan in China, the PBOC having to try and support it with the fixings. The Bank of Japan, together with the Ministry of Finance, is now looking at currency intervention because the yen has fallen so far against the dollar in such a short period of time. So I do think this is a global story, and this is very much a strong dollar story more so than anything else right now. The problem is that doesn't make countries' lives any easier. It doesn't make imports any cheaper, and it doesn't make the role of central banks any easier. I do think we will start to see this pressure alleviate over the course of the next couple of months once we start to see signs that inflation in the US has peaked and that the Federal Reserve can start to take its foot off the brake. But in the very short term, we may still see a little bit more pressure yet.
So what is your sense? Has US inflation already peaked? And will the Federal Reserve of the US still continue to hike interest rates?
I think we are at or around the peak in the US. But one lesson that we should have learned this year, which the markets seem to be taking their time in learning, is that just because we've peaked and just because there are favorable components of the inflation data which should help to drive the rate down, it doesn't mean it's going to be an easy path back to 2%, in the same way that the path towards 9.1% was far more aggressive and far more rapid than most anticipated, anyone anticipated earlier this year. I don't think the path back to 2% is going to be as straightforward as some seem to think. And I think we got a reminder of that earlier this week with the inflation data on Tuesday. This is going to be a bumpy ride. But with that in mind, I think the Federal Reserve will start to be encouraged by certain signs that will appear in the coming months. I think the jobs report that we saw for August was that Goldilocks jobs report, and I think they're going to be very encouraged by that, and one or two more of them will give them faith that they can start to slow the pace of tightening. That won't come next week. I think 75 basis points now is baked in next week. But I think going towards the end of the year, I think they will start to see signs that the inflation data is starting to fall back towards a more acceptable level, and that will enable them to further start to draw an end to this tightening cycle.
So if you are expecting another 75 basis point rate hike or 3/4 of a point from the US Federal Reserve, will this add more pressure, put more pressure on Asia's central bank to hike rates yet again, which could of course impinge on economic growth for the remainder of the year?
Short term, yes. I think we will see more pressure, maybe not to quite the same extent that we have seen over the course of the last 3 to 6 months, but I think there will be pressure on them to try and keep up to some extent with what the Federal Reserve is doing. And yes, that means more economic pressure in the shorter term, but the alternative is worse. The alternative of a much weaker currency, much higher import costs, higher inflation, and the risk of that becoming ingrained and entrenched within the economy, giving the central banks a much bigger job to do and much more economic harm down the road. That's obviously a much worse outcome. So I think in the short term, we will see central banks hiking, but maybe just not to the same degree that the US is.
But there are some central banks, like the Philippine Central Bank, which are behind the curve. They've only increased interest rates by 1.25%. Even though they did that, the Philippine peso still continues to depreciate and fall against the US dollar. We're now just 2 centavos closer to another historical low. It seems like that the central bank here is not as aggressive as other central banks in raising interest rates.
I think everyone's story is different. We look at for example, the economic damage which has potentially or arguably come as a result of the compounding pressures of higher import costs, a weaker currency, and what the central bank has done already. And different central banks have more room to maneuver than others. We look at here in the UK. They've been extremely gradual in their rate hikes, 25 basis points each move up until recently. The European Central Bank held off as long as they could. Other central banks have been far more aggressive, like the Reserve Bank of New Zealand or the Bank of Canada, because they have had almost the allowance to do so without causing too great a harm to the economy. This is all a balancing act, and I think that's the difficulty that we have here. You look at the Philippines as an example. The currency is tumbled, but so is every currency against the US dollar. It's all about limiting that harm and trying to find the right balance between managing inflation expectations, which is also critical, and also managing the economy at the same time.
Well, the Philippine peso is one of the worst performing currencies in Asia. So given the strong dollar position, which particular currencies do you like apart from the US dollar, which could still appreciate against the other currencies?
Wow, I mean, it's hard to say. We look at the state of the Canadian economy and the way that the central bank has coordinated itself, aligned itself with the US. I think that's one currency where you could say that that you can imagine can be among the better performers. I think over the medium term, I think the pound sell-off has been quite severe, and because of the recent energy price cap that's being imposed, there is potential for it to perform relatively well over the medium term. We've got to remember that the UK forecast for inflation, the Bank of England forecast for inflation prior to this price cap being announced was 13.3% later this year. Some investment banks were forecasting more than 20% later this year. The economy contracting by at least 5 consecutive quarters. This was going to be a deep and difficult recession. But this price cap does change that. And there is therefore potential, even though the Bank of England will have more to do further down the road, the fact that the economic damage is less severe could potentially allow for the currency to start to perform better over the kind of medium term. But as I say, many different central banks and many economies are struggling with a much weaker currency right now. Talking earlier about China, right, Japan, and even South Korea. There's a much longer list of those that are struggling and to support weaker currencies than there is of those who have the strengthening potential.
Craig, thank you so much for your insights on the currency markets. OANDA Senior Market Analyst Craig Erlam joining us from London.